$3 trillion. That is the total amount of wealth that evaporated from global markets in a single, brutal 60-minute window. On the floor of Wall Street, total panic set in. Retail investors scrambled to dump their portfolios as every screen around them flashed red. Normally, financial physics dictates a clear rule. When volatile tech stocks dive, frightened money runs straight into safe haven assets. You expect gold and silver to shoot straight up. But look at this. This chart shows the real-time pricing for stocks, gold, silver, and crypto during that hour. All four lines plunge down in perfect synchronization. That contradicts every traditional rule of the market. Retail panic does not look like this. When every asset class liquidates at the exact same second, you are watching highly coordinated institutional selling. The smart money decided to exit, and they took their cash all at once. Markets have been operating on a very expensive illusion. Now that the bubble is bursting, that vanished $3 trillion is merely the first domino in a much longer chain reaction. For the last year, we were told artificial intelligence is an unstoppable, guaranteed money machine that will generate decades of profit. The reality is far less glamorous. The massive valuations of companies like NVIDIA were driven primarily by access to zero-interest loans, literally free money pumped in by the banks. Building out this infrastructure costs billions. The tech giants themselves admit that widespread profitability for these massive data centers remains a decade away. But the era of free money is officially over. Central banks, specifically the U.S. Federal Reserve, are completely shutting off the tap. Why wait 10 years for an AI payout when the government will pay you a guaranteed, risk-free return right now? Institutional money did the math and instantly pulled out of tech stocks, trading at 40 times their actual earnings. This capital flight targets hardware and chip manufacturers the hardest. Companies like Intel require relentless, massive cash injections just to keep their foundries running. The tech crash did not happen because AI failed. The cheap debt holding the entire sector up simply collapsed. We are currently operating in a twisted economy where good news actually triggers panic. Recent data showed a massive spike in U.S. employment. While people getting jobs sounds positive, Wall Street realized that more wages mean higher consumer spending, which instantly reignites inflation. To fight that incoming inflation, the new Federal Reserve leadership under Kevin Warsh has no choice. They have to push interest rates back up to 4 or 4.5%. Warsh also made a harsh procedural change. He cut off Wall Street's access to predictive interest rate data. Suddenly, traders were flying blind, stripped of their forward guidance safety net. Institutional elites exploited this exact moment of terror. They used the confusion to heavily short safe haven commodities, driving gold down 3% in a matter of minutes. It is a classic retail trap. Weak, fearful investors see the drop and panic sell their holdings at massive losses. Meanwhile, the cash-rich institutions wait at the bottom to vacuum up those exact same assets at rock-bottom prices. They pushed silver down even further, a full 7% drop. It forces a rapid transfer of wealth, straight from the middle class into the pockets of Wall Street. This commodity crash bypassed organic market reactions completely. Institutions manufactured a daylight robbery using the threat of inflation. The domestic fallout in America will be immediate. As interest rates spike, mortgage costs will skyrocket, entirely freezing the U.S. housing market. Average Americans, already living on credit cards, will begin defaulting as their borrowing costs double. That pain will not stay within U.S. borders. When American interest rates rise, foreign institutional investors immediately pull their capital out of emerging global markets. That capital flight is going to hit India hard. Foreign investors will create immense selling pressure on the Indian stock market as they liquidate their positions and run back to the safety and high yield of the U.S. dollar. Then comes the secondary wave. As U.S. corporations lose their cheap credit, they will drastically slash their tech spending, drying up vital contracts for the Indian IT outsourcing sector. This creates the ultimate gridlock for the Reserve Bank of India. They desperately want to cut domestic interest rates to stimulate local growth, but they are trapped by the Federal Reserve. If the RBI cuts their rates while the U.S. raises theirs, the value of the Indian rupee will collapse against the dollar. They are stuck between crushing domestic growth or destroying their currency. This chart shows the projected path forward. Assuming no new geopolitical wars break out to spike inflation further, strict fiscal management could gradually guide the rupee back down to a strong 82 to 83 range by December 2026. Once you see how these macro dominoes are stacked, the sudden market crash makes perfect sense. Ignore the engineered panic, track where the smart money is actually going, and you can survive the wealth transfer intact.